Hello everyone and welcome back to the discussion on equity valuation. Under the heading equity valuation, we are going to discuss discounted dividend model. So what exactly is discounted dividend model? You have learnt already, correct? In your past, right from the earlier levels you have been learning the discounted dividend model. Now, this indicates one thing very clearly, that the value of equity today, is nothing but the present value of all the dividend cash flows that you are going to receive, correct? If you are purchasing equity share of a company today, if you are investing in equity of any corporation today, you are going to have rights to receive dividends. Now, up to when will you get that right to receive dividend? Up to when? So, the existence of equity instrument in a corporation or in a company is assumed to be perpetual, correct? So, as long as the company exists, you will be receiving dividends for an infinite period. So, infinite period dividends that you are going to receive, that entire dividend you will discount to its present value. Now, the existence of the instrument may be perpetual. This is something important what I am mentioning. Existence of an instrument may be perpetual, but your plan to stay invested as ordinary stockholder or equity shareholder of that particular corporation may not be perpetual. You would have your own investment plan. You would have decided to invest your money for a certain number of years, that is for a finite number of years. But company is not going to give you back your money after those finite years, because this is equity instrument. You will be getting back your money only and only when the company goes for liquidation. You know it very well. Otherwise, money that you have invested, the value that you have invested for buying that equity or buying that stock or share, that you cannot get back from the company until it is going for liquidation or it is going for winding up. However, there are financial markets. Any instrument that you are holding, you can always sell. So, suppose your investment plan is only for 3 years. Then what you will do? You will receive dividend for the first year, that is D1. We resemble dividend that you are going to receive in the first year as D1. Then you will receive dividend for second year, that is D2. Then you will receive dividend for the third year, that is D3. So 3 years you have decided to stay invested in that equity. So you are going to receive dividend 3 times, D1, D2, D3. And what happens at end of third year? Company is not going to wind up. You are not going to get back your money from the company, but you can sell your share in the market. At the end of third year, the price of the share is resembled as P. The current price will be P0. Price after 1 year will be P1. Price after 2 years will be P2. Price after 3 years will be P3. That means P3 also you are planning to receive as a cash flow. So which all cash flows you are going to receive if your investment horizon you have planned for 3 years? D1, D2, D3 and P3. All these cash flows you discount to their present values. That cumulative present value will be the value of your equity. This is called intrinsic value of equity. Intrinsic value. What is the purpose of determining this intrinsic value? What is the purpose? See, fundamental analysis, when we talk about, See, you are going to determine the intrinsic value of that equity, and then you will compare the quoted market price with that computed intrinsic value. For example, there is a corporation whose stock is traded at, say, $26.5. Now, whether $26.5 is the fair value or not, you would want to arrive at that, and therefore you determine P0 value as a present value of all the future cash flows that you are expecting to receive over your time horizon of investment. The cumulative present value of all the future cash flows that you are expecting to receive will be resembling as the intrinsic value. The cumulative present value will be the intrinsic value. Let us assume that the intrinsic value of that share is $25, but the quoted market price is $26.5. Now what you will do? You find that the quoted market price is greater than the intrinsic value that you have computed. That means in the market, in the secondary market where these stocks are traded among the investors, this is overpriced. You can call it overpriced or overvalued. Any stock, rather any instrument which is overpriced or overvalued, you would not want to buy that. Instead, if you are holding such stock, it gives you a signal that this is a good opportunity for you to sell it. Any overvalued security, you would want to sell it at its current market price. Any undervalued security, you would want to buy it at its current market price. Now, just let me remind you, if at all you are computing the present value, you need a discounting rate. Now, what will be the discounting rate? The discounting rate over here will be your required rate of return as an equity investor. Your required rate of return on that particular stock in which you have invested your money. When I say your required rate of return, what is this required rate of return? See, computing present value for you is not a big thing now. You have been learning right from junior levels, right? How to compute present values. You have learnt it so many times. So nobody is keen on testing your knowledge of computing present values. Understand this point. Examiner would want to assess your knowledge on whether you are fine-tuned with the concepts. So from where do you get this discounting rate is a fundamental issue, and that discounting rate is the required rate of return by the investor. The required rate of return by the investor is obtained through market reference. So what you do is, there will always be some information available. There will always be some information available about a risk-free rate. Maybe on government securities, what rate of return is being offered at present can be referred to as risk-free rate. That is the rate of return on government securities, risk-free rate. But when you are investing your money in an equity instrument which is not free from risk, it is filled with risk, you might want to make risk adjustment. Now, risk adjustment can be made by multiple ways. You can follow models like capital asset pricing model, you can follow arbitrage pricing theory model, or you can have any other manner of adjusting risk to your risk-free rate so that your rate of return that you are expecting, which you are defining as the required rate of return, becomes the point which is accommodating every factor that you should consider for your required rate of return. Let me clarify this point. This may even include components like opportunity cost of capital, Now, what do we mean by opportunity cost of capital? Suppose you have similar kind of investment opportunity in equivalent risk class. I repeat, you have similar kind of investment opportunity in equivalent risk class, and suppose that you are going to get returns at the rate of 25% on those investments. If you are not making investment there and making investment here, there you are sacrificing an opportunity to earn 25%. That opportunity lost becomes your opportunity cost. Keep in mind one thing, what I said, that opportunity lost becomes your opportunity cost, and that becomes your cutoff rate or minimum required rate of return. You are okay to earn something more than that, but definitely not okay to earn anything less than that, and that becomes your required rate of return. Your required rate of return, when you determine, it can have various aspects. Your cost of capital, that is, what is the cost of funds that you are arranging, your risk factors which have been accommodated in this particular investment decision, that is all the risk adjustments on a risk-free rate, what is a market reference rate as a risk-free rate, what could be your opportunity cost of capital. All these issues you need to consider to land up at required rate of return for the investor. Now please understand one thing, there is a term called internal rate of return. What is internal rate of return and how does it differ from the required rate of return? See, every investment you make, that investment or that security in which you have invested will have some potential of generating returns. The potential of generating returns by any investment is called its internal rate of return. It is indicating the yield provided by that security to you. You are the investor. What yield you are actually going to earn is the internal rate of return. On the other side, in your mind, you have your own required rate of return. So let us take examples to understand basic things. Suppose your required rate of return, which resembles your opportunity cost of capital, is say 25%. Say you have sacrificed 25% by not investing in another stock which is belonging to the equivalent risk class. So you expect nothing less than 25% from this investment as well. So you are planning whether you should invest your money into this particular stock which I am proposing to you. So your required rate of return will be your opportunity cost of capital, that in my example is 25%. So when you have to target 25% return and then you observe that what is the return generating potential of this stock that you are talking about. So here you look into the historical data. The historical returns of this particular stock is providing evidence of internal rate of return of 28%. So you have looked into historical data. This is in the past, correct? When I say historical data, it has already happened. But what happens when you observe that a stock has potential of generating 28% returns by far, you always presume that ahead also the stock will continue to generate this kind of returns. Therefore, this is considered as internal rate of return of that particular investment. So you find that internal rate of return IRR is greater than required rate of return, that is RRR. If IRR is greater than RRR, you have to think and decide whether it is a favorable condition to invest or not. So come on, I am asking you all a question. You need to just respond by mentioning yes or no. My question is, if IRR is greater than RRR, if internal rate of return is greater than the required rate of return, will you prefer investing in this particular stock or not? I want answer in one word, yes or no. Come on, start giving your responses. I am waiting. The obvious answer is yes. See, now you have understood one clear thing, that internal rate of return is indicating the potential of return generating capacity of a stock, whereas required rate of return is the rate of return that you want, and you have obtained this through your opportunity cost of capital and various other elements that you would have considered in arriving at your discounting rate. So your discounting rate should not be internal rate of return, your discounting rate should be the required rate of return. Now, when you are computing price of the share today, you generally resemble that as P0, correct? P0 is the symbol used for determining the value of the share today. See, what you are computing cannot be the quoted market price. What you are computing is the intrinsic value. That you have to compare with quoted market price and then decide whether you should invest in this stock or not. So when you are comparing price with price, it is price comparison, correct? Over there, you will identify whether the stock is underpriced, overpriced or fairly priced. Accordingly, you take your investment decision. Alternatively, you may compare the two rates of returns and decide whether you should invest into this stock or not. And what are those two rates of returns? Internal rate of return and the required rate of return. Now, when we talk about the required rate of return for an equity investor, it is resembled as KE. KE is the symbol used for expressing the required rate of return or the expected rate of return by the equity shareholder or the equity investor. What you are referring to KE as the required rate of return for the investor, the same thing becomes the cost of equity for the company. Now, this is something important. See, in case of debt instruments like bonds, debentures, you would find that if the company has to determine its cost of debt, one way could be it can determine the YTM of such instrument, and the post-tax YTM will become the cost of debt for the company, because we always want to express the cost of capital as a post-tax element. What is YTM? It is nothing but the IRR of that debt instrument. That is the fundamental concept that you apply everywhere. However, when you are talking about cost of debt, here you have to define what all cash flows have been defined towards interest payments or coupon payments to your bondholder, and accordingly, based on the cash flows that you have promised, you are going to find the discounted value, which will indicate the value of the bond or any other debt instrument, where the promised cash flows present value you have to determine. But in an equity investment, where one party is the investor and one party is the issuer. So assume that I am the corporation or I am the company, I am issuing equity and you are subscribing to the same, means you are the investor. So you are not being promised any cash flow, because the definition of equity is taking you to a fundamental point that whatever be the residual value of the entity, that belongs to the equity investor. So someone who is holding the equity instrument in an entity is participating in the residual value, or you can say that investor has the residuary interest in the company. So company doesn't promise any specific cash flow. I am sure you are able to distinguish. Suppose you are purchasing bond issued by my company, then you have definite cash flows to be obtained at definite point of time. But if you are purchasing equity share of this company, you don't have any definite cash flows to be obtained at any definite point of time. Therefore, there is a big difference when we determine the cost of debt for the company and cost of equity for the company. Cost of debt and cost of equity both have one thing in common, that they are based on the present value of the future promised or expected cash flows. But in case of bonds and debt instruments, it is present value of the promised cash flows. In case of equity investments or equity instruments, it is a present value of expected cash flows. Therefore, in case of debt, what the issuer promises becomes the base of the calculation, and in case of equity, whatever is expected by the equity investor becomes the cost for the company, because what rate of return is expected by an equity investor who is precisely the owner of the company. If you understand it very well, equity investors are typically the owners of the company. They are the owners of the entity. So whatever they expect, that becomes the cost of equity for the company. So the symbol used for the required rate of return by an equity investor is KE. KE indicates cost of equity for the company. It indicates the expected rate of return or the required rate of return by the equity investor, and it also resembles equity capitalization rate. So what I am going to do is, I am going to provide to you some important notes under the discounted dividend model of equity valuation, and you quickly take note of everything, and when I take you further, you make sure that one thing is clear before you are moving on further, so that your concept clarity is at the peak. So let us first write some important notes. First thing what I would want you all to do is write this heading equity valuation and the subheading as dividend discount model, and under this heading you please proceed and start writing under the heading dividend discount model. The dividend discount model, or simply stated DDM, is based on the rationale that the intrinsic value of stock is the present value of its future dividends. The most general form of the model is as follows. Now please don't get worried with this kind of formula coming in front of you. Let me explain this thing. V0 indicates the intrinsic value or the present value of all these future cash flows. Can you notice DT? T indicates the time factor. So it will be D1, D2, D3, D4, so on, so on, so on. And look at the T as the variable over here. Interval of T is resembled as 1 year, and the limit of that goes infinite. That means you are considering the infinite period. So if it is D1, it will be discounted at KE rate. So it will be D1 divided by 1 plus KE raised to 1. If it is D2, it will be divided by 1 plus KE raised to 2, and so on. So you may write the meaning of these symbols. V0 is the current stock value, and DT is the dividend at time T, and KE is the required rate of return on common equity. So please write up these notes and then I take you ahead.